Steve Aul, want to welcome you all to tonight's town hall meeting. I'm going to go ahead and stop the share to pull all the disclaimers and all that good stuff off of the thing. Again, we just like to thank those that are in attendance when we do this live and those that listen to it later. As I've stated over and over again, the last 12 months have been the best for us since we've been in business with referrals from clients. So sending your friends to us is one of the greatest compliments that we could get. And we deeply want to thank everybody that has done that this year. We are looking at it, and I'm going to put everybody on the spot, but I would love to do a July Friday event. We obviously can't do First Friday because that would be, in the 4th of July weekend. But I'm thinking about, I could put Mel on the spot and we could probably get one of these pulled off by about the third week of July. Is pull one of these off and just have everybody come into the office and do what we've done in the past and kind of enjoy life and say, okay, let's do the first post-pandemic First Friday at the Aul Financial Group on the 3rd Friday of the month. So I know that sounds good. And Chris, you're going to make me sound good. So that's just one of the things I was kind of thinking of from there. We kind of like to go through the town hall of just something that's on our mind. I did ask this time if we were all going to talk about inflation, and they said no. So I'm going to go ahead and turn it over to Miss Deanna so that she could go ahead and kick us off on this town hall events. Thank you all for being here.
Thanks, Steve. Mel always accuses me of being the downer. Now that you're all depressed. But I do want to say, if you have not been in the office recently, we are a fully vaccinated office. So that's important to share for folks as we're getting back out and doing things in person. It's been nice. So yes, Steve, if you're going to do a 3rd Friday, First Friday event, I count me in. So I did want to share something. Yes, Mel, it's a Debbie Downer moment. And Warren Buffett wrote this to his in his annual letter that fixed income investors worldwide face a bleak future, that bonds are not the place to be these days. And we've been saying this for a while now. I mean, we understand that yields are so drastically low, but U.S. government bonds, keep in mind, U.S. government bonds, which have a market cap that's 2 times the U.S. stock market, have all entered a bear market. And I'll show you this slide here in a minute. All the segments of the Treasury yield curve are now in a downward trend over short and intermediate timeframes. And considering that total returns have been negative for a year or more, that's pretty concerning, especially when you consider bond investing make up the traditional 60-40 portfolio or more, usually higher for individuals that are approaching retirement. That has been the customary recommendation, is to move into bonds to protect a portion of the portfolio. And now, if you've worked with us for any length of time, you know that we have some other tools up our sleeve that we use as a bond alternative, but it's becoming even more imperative that you look at other sources for protection on your nest egg. So corporate bonds typically are correlated to stocks, and they can be very susceptible to large drawdowns. On the other hand, Treasury bonds have traditionally done a better job of offsetting the equity downside. They don't have as much volatility, which is why they don't return the same yields. But I'll share this screen with you just so you can see what kind of territory we're in right now. Hold on a second. Where did it go? All right, can you guys see this chart? Yep, you can see it. Okay. So this is just, they have officially entered the bear territory, And these are the yields starting back mid 2020 out till today. You can see where how much farther down they are than the traditional averages. And again, they've been in negative territory for over a year. So, but now they're negative. So again, this is concerning. If you're looking for safety, you've got to look at other alternatives besides bonds. They're going to be taking it on the chin, especially when if we do have any increase in yields going forward. Even the yields that you've gotten, or the bond prices that you have in your portfolio now, will then begin to shrink. There's just going to be a big sell-off. So it's something to be aware of if you have these positions in your portfolio now, which if you have a traditional portfolio, I suspect that you do. And we may want to have a conversation about other alternatives, which I'm sure Mel would be more than happy to fill you in on the many alternatives there are. And it's a tough transition, especially going into retirement, you know, when our focus has always been on returns. Well, when you stop working, not only does your focus switch from your net worth, you have to start looking at your cash flows and the return of your money, not always the return on your money. So cash flow is king in retirement, and there are a lot of things that you can do. Certainly don't want to put everything into a safety bubble, but it's imperative now, especially as we look to the horizon of increased taxes, which you know are coming. And if they do end up raising yields, the current environment is going to get ugly. So I'm going to pass it over to Mel. Maybe he's got something to add to that. But that was my Debbie Downer news for today's town hall.
That is not depressing. That's music to my ears. But been saying it for 25 years that there's a better alternative, and I've been right all along.
Do you guys see it? It's like, Mel, you were right.
Well, I've always known that, you know. It is important because, and we will probably be looking at rebalancing a lot of different portfolios that we're currently managing. One of the things that it does not make sense to have, I have safe money over here that I don't have to worry about. Now let's take the rest of my money and make part of it income and part of it growth. No, that income portion belongs over here. And then you can be all growth on this side and actually even end up being a lot better off in the long run. So it is something that going forward, as this continues, some rebalancing of our current clients and current structures will probably take place because there's not really any other safe harbor out there other than what we've been using all along. And we have some new tools in the box that will allow us to perform that job even better. My subject tonight is a little bit different, though. I'm actually going to be talking about the doom and gloom of the current housing market. Now, that sounds really weird to say it that way. Yeah, oh my gosh, yeah. But here's the thing. Dr. Shiller, Robert Shiller is a Nobel Prize winning economist, runs the Shiller Housing Cape Index, and then also the Shiller Cape that we use in one of our annuity products that has been the best income or growth product index of any indexed annuity in history for the last going on 16 years now. What he is saying about the current housing market is that this is a little like it was last time with the bubble in the mid-aughts, but not quite. Back then, it was driven by the mortgage lending and things of that nature. Today, he's actually call it excessive exuberance, which we've heard that term before. So there is no real reason for the housing market to be going crazy and people calling up and bidding 20% over asking price for houses and just buying them up left and right as fast as possible. There is no real solid foundational reason for that. And we are in it's similar to a bubble, but he expects it to last for maybe another year. And so then there will be some correction and it will be painful. but not like it was last time. It won't lead to the Great Recession that we had in 07, 08, 09, things of that nature. But people who are buying these houses, and the actual medium home existing price is around $341,000 nationally. Okay, that is up 19.1% since April of last year. And the worst place in the country for that is Phoenix, where it's up over in excess of 20% in 1 year. So it has aspects of the bubble, but a lot of people who are buying these houses, especially if they're overextending, and it's not like it was before, where people who were getting money who would never be able to pay it back, much less in the normal circumstances. Now people are committing very large portions of their asset base into the houses. Part of it is being driven by the pandemic changes in our society, where we suddenly realize I don't need to live in New York City or Chicago or LA. I can live in Idaho and work for the same company using the internet. There is a lot of that, and there are a lot of companies that will probably never go back to full office type structures. But the gist of what I wanted to say there, we have better protections this time against the over lending or lending to people who can't repay the loans. We have a little bit better structure on the housing market and things of that nature. But primarily what we're talking about here is the people that I feel really know what the heck they're talking about are saying we're probably going to see another 12 months or so of housing price increases, but there is going to come a reckoning where things might go back toward a more normal. So if you paid $340,000 for a $200,000 house, then you might be underwater, within 12, 18, 24 months. Now, given enough time, you might actually climb back out of that hole. But I would be very, very careful, especially if you're talking about in the rental business and things of that nature, of overpaying for the properties at this point. It might be a really good idea if we're thinking about buying that new house or building a house. You might want to give it a year to give it some real consideration about what's happening. First of all, supplies will be better. Lumber is outrageously expensive right now because of the pandemic. People weren't working. It wasn't going out there. A lot of stuff that you would need for a remodel is not available because of manufacturing. That wasn't available at the time. So there's just a lot of different things that are contributing to higher prices, a drive for the houses, a drive for people, a little bit of a feeding frenzy on buying up properties. And at some point that could come back to bite us pretty hard. So I would just recommend some caution along those lines. That's mine.
All righty. Thank you, Mel. I'm going to go in a direction that I think will probably end up surprising everybody. But one of the articles that I read was when they ask seniors what their biggest regret was. Most of them, they said there were 22 million seniors wish they would have considered the major retirement expense of taxes. It's the most underestimated for people that are not using financial advisors, financial planners. And I know everybody that's a client, listen, that we talk about it a lot. It's taxes. So that's the thing that they didn't think about. They didn't think about the fact that they were going to have to pay taxes on their Social Security. They didn't think about the fact when they go to required minimum distributions that they could be kicked into a higher tax bracket. And they also didn't think about, with the death of a loved one, how that could put them into that higher tax bracket. So that's one of the things that I want to look at. And I know we've talked about it over and over and over again with most of our clients. We've talked to a lot of our clients about Roth conversions. We've also talked to a lot of our clients about the life insurance financial tools, where we're actually moving some of those tax deferred assets, paying the tax on it, and putting the balance into a vehicle that can grow tax deferred. And then if we take it out properly, it's tax free, could possibly be used for long-term care exposure if we had one, and there would be a death benefit. We've talked to a lot of people about that idea being for you. But with the changes around the Roth IRA, where we no longer can stretch it over our kids' lifetime, we've lost a tool for legacy for grandkids. But we can also look at it now where that life insurance financial plan that we talked about for you could be very beneficial now to actually go down one generation and look at it for our children. That gives them the availability to have the insurance in case something would happen to them. You would have the opportunity to take the income out of it. The kids would then have the opportunity, if they were good stewards of the money, to take income if you didn't need it. And then if they didn't, and they were good stewards, it could pass down to the grandkids that may be here now or might be here in the future. The government continually changes the way that we can pass money on to heirs. And that's why we believe it's our job to stay up on these things, to find out how can we pass money from one generation to another when the 430 some people in Congress want to change the rules all the time. So that's one of the things that I wanted to mention. If we've talked to you about it and you just didn't sound like a good idea at the time, let's come back in and revisit this on how it might be beneficial to go to the next generation so that we can pass it on to our grandchildren, because we think that legacy issues are going to continue to get more difficult. If a lot of the balloons that Joe Biden's administration are floating right now actually make it through Congress, which I'm not sure how many of them will, but if they actually do, passing assets to a second generation is going to get more difficult and more difficult. And those are the things for those of us that have saved. That's why we did it. We wanted to be able to pass it. Let's talk about some tools that might be able to be used for that. What's the biggest regret? People didn't think about taxes. And everybody that I've talked to in the since the election, they will be higher in the future. So I have not gotten a lot of no, tax rates are going to be lower in the future statements that have come out of that. So again, I want to thank everybody for all you've done for us. I'm going to ask one more favor of you all. We are in the process of bringing in a new receptionist. If you know anybody out there that it might be a good job for them, have them give us a call at the office. I'm going to have Chris go ahead and put that out in probably the newsletter that announces this, to sit here and say, again, you're our greatest source of referrals. You're our greatest compliments when we say it. If you know somebody that might be looking for that position, please don't hesitate to have them give me a call. I'm going to go ahead and say thank you again, and I am going to stop the recording.